For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Hey, welcome back. Thank you so much. Johnny Dean, your podcast host. Where have we been the last couple of weeks? Well, we've been around. Professor Rick Plum.
Been everywhere.
CFP professional, certified financial planner professional. Welcome back. I was told this is the start of the new season. I forgot to say on our last new podcast, which was about 2 or 3 weeks ago, that was the end of the season. And
whatever a season to
I was
us
told,
means.
I don't know, it's like 10, 12 episodes, something like that.
Then we take a week off and we start a new one.
We take a week or two.
Yeah, 2 weeks.
Yeah, just depends. And in the summer, which is where we are right now, we're a little loosey-goosey with it. But we're back for season whatever number it is, doesn't matter. We've done a ton of these episodes, and we're happy to bring you things. During that time off, I was looking at things that we haven't talked about for a while, or ever, as a matter of fact. You know, we try to keep it current. We try to keep it we try to give you topics that are relevant to as many people as possible. And today's topic is actually more relevant than I think many people might believe. And it has to do with alternative investments. Now, Professor, we can talk for a moment about what they are. But when you think of regular investments...
Well, you think of stocks, bonds, and cash. Those are what people consider to be normal, typical financial investments. You know, and then outside of it, and people think they have a pretty good idea of how they work. You know, cash is pretty safe. You got FDIC in some of it. Money markets don't have FDIC, but they tend to stay very stable. Each share price of a money market fund is $1.
Usually $1 stays $1.
Yeah, $1 is $1, and it earns some interest. CDs, they're bank accounts that earn interest, but you're locked in for a little bit of time, and you get hopefully a little better rate of return.
Mm-hmm.
Bonds, and stocks are an ownership of the company, and so you are entitled to the profits, or you can sell that share for hopefully a profit. You buy it at one level and you sell it for more as the company gets bigger and more valuable.
You hope.
That's the goal. The one I think that's misunderstood the most are bonds. It seems a little weird. They seem pretty straightforward, but people forget or don't understand the relationship between interest rates and bonds and how they're priced and what's going on with them. And that they're, if I have a bond that's a $10,000 bond, it's not always worth $10,000 depending upon what's going on out there. And it depends on what kind of bond it is. Is it a mortgage bond? Because that has a difference in price, because mortgages get paid back over time. They're amortized. And so, you're getting, your payment is in many cases, principal and interest. Mm-hmm. So it's self-depleting, so to speak. But they're kind of known as the typical investments, stocks, bonds, and cash. That's what traditional investing is all about.
Even if people don't always understand how stocks or bonds work, most people probably know how cash works. But even if they don't understand, those are kind of the standard types of investments.
And that's what the typical mutual funds are made out of as well, stocks, bonds, and cash.
Yeah, okay. All right. Well, there you go.
That's what you have usually available to you in your 401ks.
Now, one of the things that some people may consider, and I'll say up front that alternative type investments are not for everybody, certainly. But explain for just a moment what an alternative might be. Now, besides saying anything that's not stock, bond, or cash.
Well, that's the easy answer.
It is the easy answer. But some examples of this, generically speaking.
Real estate, private lending. Instead of me going out and buying a bond, which is me basically loaning money to a corporation, do it on a smaller scale. Mm-hmm. Alternative investing typically is something outside of the typical stock, bond, and cash that has its own set of risk factors. The risk factors may be influenced by broad news across the spectrum or very specific information to one person. Maybe if you own a rental house and your renter leaves, you lose all your income until you get another renter in. Or that's very tightly, and that's very specific to that one issue. Whereas if I own a mutual fund that or some kind of investment that has hundreds and hundreds of buildings or tenants. If I lose one tenant, I lose a small portion of my income. I don't lose the entire income. So
like a real estate investment trust kind of thing, maybe.
Or even, if I'm looking at, it's something that is different. It has a different risk characteristic.
Are commodities considered alternatives?
By many people, yes. And commodity trading, commodity
gold,
investing.
things like that.
And gold, people get excited about gold. Gold is more difficult. I mean, I can't just go buy gold. I mean, if I buy a share of stock, it's fairly straightforward. But if gold, what am I going to do with the gold? Now I have to find a place to store it.
Yeah.
I've got, I'd better not tell anybody where it is. But I mean, it has a different set of risk characteristics. It doesn't, the information that affects stocks and bonds may or may not affect gold in the same manner, same direction, things of that nature. So all these different types of investments, and it's harder just to go and buy that. You hear a lot of gold advertising, but a lot of it is in the form of coins and other things. And so how do you actually buy
commercialization of that?
And so there's lots of different forms of gold. I mean,
commodities could be considered.
And commodities don't act the same way as, typically we think in a recession, our investment's going to go down.
Your investments, meaning your stock portfolio.
Right. When the markets, when the markets are going up, when people are reporting on the markets, they're reporting on the stock market or the bond market. They're typically not reporting, at least not in general terms, on the commodities market. They're typically not.
Or the real estate market.
Unless it's really bad or unless it's really, really good. The real estate market is up. The real estate market is hot. One of the problems with real estate, though, has been the cost to get into that type of an investment. I mean, with stocks and bonds and mutual funds, you can get in for a fairly low initial investment amount. To buy a property, a single property or multiple properties, usually takes a lot more money, and you've got to be able to qualify for the loan if you're not doing a lot of money. And so alternatives have typically been something that is not as easy to get into, something that has a little bit different risk characteristic. But over the years, there have been funds and things set up so that average people can get into these types of alternative investing, get into real estate without owning or without having $1 million to your name ready to put down on a building somewhere, without, and get into private lending and hopefully get into a point where you can make loans to quality companies rather than individuals who may or may not pay you back.
Now, why would somebody consider alternatives? I mean, there are plenty of people who do just fine with the stocks, bonds, and cash. And certainly there are some people who should not consider them. But first, before we get into the pros and cons of things like alternative investments, why would an individual consider an alternative type of investment?
For something I mentioned earlier, the different risk return characteristic. They act differently. They move based on information differently. So information that is just having fits at the stock market level may not be affecting the real estate market. And so or the alternative market. So your alternatives may buoy the portfolio in times of downturns in the markets. And the easy one to think about is, we'll go back to real estate. And people, they look at 2008, the stock market went down quite a bit.
Yeah.
And they talk about real estate being a horrible investment at that time. Real estate didn't really hit the skids until a year or two later. And they didn't hit the bottom. Real estate was going gangbusters and stocks were going gangbusters. 2003, 4, 5, 6. In 2007, the stock market cooled. The real estate market didn't cool in 7. Real estate market started to cool in 2009, 10. By that time, the stock market had already bottomed and was coming back up. And the real estate market was heading down in 2010, 11, 12. Didn't hit the bottom, at least the personal real estate market, until 2011, 12, 13. And by that time, the stock market had recovered and done everything. So they were working at different angles.
It's what they call a discorrelation, I guess. Is that the correct word?
Yes.
Not correlated. In other words, the stock market and they don't move in lockstep.
Right, but they both
many
have
cases.
Swings in value.
Sure.
I mean, I'm not saying either one of them is guaranteed in any way, shape, or form. And so they have different flavors, different characteristics. Alternative investing, in many cases, can be done with higher cash flow. And so maybe, when people talk about returns of real estate being so great, a lot of it is, yes, okay, lately we've had a lot of appreciation, a little bit of depreciation in real estate, but over longer periods of time, a lot of the return comes from not just the appreciation of the physical property, but in the cash flow that can be generated from it as well. So where a stock, may grow at 10% a year, and 9 of it is coming from appreciation in value and maybe 1% from cash flow dividends. Real estate, I mean, if you look at the historical, take this last couple of years out of it, rate of return on real estate, it's not much more than inflation in general, and maybe a little bit more than inflation, but people make a lot more money in real estate, not because of that, but because of the value of the income that's coming in. And one other factor with real estate that helps people make a lot of money in real estate is the leverage, the ability to, buy $1 million property with $200,000 and have an $80,000 loan or $800,000 loan and have it rented out. Somebody else is making the payments. Basically, they're paying you and you're making the payments with their money.
A renter is.
And so your out of pocket is that initial $200,000. Now, if that property goes up by 5%, $1 million, 5%, that's $50,000. My equity went from $200,000 to $250,000. My equity went up by 25%. That's where it looks really attractive. Of course, if it goes down 5%, I lost 33% of my equity.
risk.
So
sure.
But you typically don't see that kind of investing style in stocks or in bonds for that matter, unless you're a margin investor, and that gets really crazy as well. But not that many people use margin. But most people that are buying stocks and bonds don't do it with leverage.
Yeah.
So
in real estate, plus there's a time factor too.
Right. Getting in and out, it's not liquid. I mean, if I get mad, and this is what has helped illiquid investments like real estate. When markets go down, assuming you're not over leveraged and you don't lose it because you can't make the payment anymore, people will hold on to a real estate project longer. They expect to be in it longer. They may badmouth it the whole way through the downturn and say, "Oh man, I can't handle this. This rental property's killing me." I mean, it's like the renters are just doing this and this, but they end up holding it, and all of a sudden they realize, "Wow, I made some money."
Well, it's
whereas with the stock, when they get mad at it, they wake up and they have a nightmare about it. They go online, they put it in order, it's gone the next day.
Yeah, that can be one of the helpful good sides, I guess.
Not being able to sell something just because you're mad at it for the moment actually has helped people make money in real estate. At times.
Yeah,
and that's what has screwed up a lot of investors in traditional investing, stocks and bonds.
What typically, the best? I read somewhere where typically the best performing asset that people have in general, this isn't true of everybody, is real estate, their home. Now, it's not because their home is going up in value so much every year, or it's a great investment. I mean, as you said, it might go up at the rate of inflation, something like that on average, which isn't a ton, but it's the only type of asset where people give time a fighting chance to work, compounding over time.
Yes, and the other side of it is they're obviously making a payment for most of the housing out there, but they would have been paying rent somewhere else.
Yeah, so that's
the different. Although they're probably paying a higher mortgage than they pay rent, maybe not. At least at start. But it's money that they were going to be spending anyway. Now, owning a house does cost more than renting in many cases because there's all the maintenance and you typically want to do more things.
Is real estate maybe in commodities? Are those some of the most common types of alternatives when we talk about that?
Right. I mean, there's different types of trading techniques using stocks that would be considered alternatives as well. Long short funds and different and using leverage. Going into leveraged types of ETFs and things of that nature. Those would be, I would say, alternatives because they're not mainstream. They take a little bit more understanding. They take a little bit more knowledge. It has a different risk profile than just a typical stock investment. And so how you're going to apply these, and there's lots of different types of alternatives. We just brought up a couple of the more popular ones. And people will use them as a hedge against the other stock market investments as a way to create different types of return. Like I said, more cash flow oriented returns.
Does it potentially mitigate their risk?
it changes their risk. And if you couple it with other investments that have a discorrelating or a negative correlation of risk, now you can take the entire portfolio, and it tends to have a lower overall volatility. Because if you've got something that goes down when this is going up, then you don't have the huge swings. If all you have is the one asset and it goes up or down dramatically, yeah, you've got a lot of volatility. I'm not saying that is a direct correlation with risk, but if you've got something that goes up when this is going down, it goes down when this is going up, my overall volatility of my whole entire portfolio, I don't have the high highs and I don't have the low lows. Because something is going up while something is going down, something is going down while something is going up. So it tends to have, if I just look at my bottom line, which is actually not that uncommon. A lot of people just look at what's my value today? Did it go up or did it go down? It doesn't have the dramatic swings. So it's just a matter of trying to put things together. I mean, we do this even within traditional investing. We try to, blend investments, stocks. Let's say you have 100% stocks. You don't have 100% of, you typically don't have one stock. You have multiple stocks. And the stocks that you have aren't in the same industry. So that if news about one industry affects everybody, your entire portfolio goes down, even though you've got 10 or 15 stocks. You have different size companies. You have, small companies that tend to do better at different times of the economic cycle, and you have large companies that do better at different
it's
different
discorrelation within
the stocks, and then you take that and you add different types of investments outside of that. Typically, though, the alternatives take a little bit more understanding, a little more sophisticated investor.
All right. Well, okay. So there you go. That kind of leads into my next question for you, which is, if you're sitting across the desk from someone, what would trigger you to something that they say to say, well, there are alternative investments out there? Because clearly, as we said, they're not for everybody. But what would
size of the portfolio, understanding of risk and return, understanding of their own risk tolerance. Those are all factors that go into, and obviously what's available, what's moving, what's trending, what's happening in the world, what's available. Those all come into play. I was speaking with somebody just the other day, and they don't like stocks and bonds. They feel that they're manipulated too much by the big players and the governments and things, and so they want more outside of it. They want more real estate or first trust deeds of instead of a bond fund,
owning mortgages,
owning a first trust deed on a property. They figure, well, I'm going to get paid or I'm going to get the property. Which is fine. They take a little bit more work. You have to have a little bit better understanding of what's going on. They want to buy properties that are cash flowing and do things of that nature rather than buying stocks. They feel more comfortable with it. That isn't the most common way, but it's not a bad way if you understand what you're getting into.
Okay, so let me run down some potential upsides to alternatives and downsides as well. We'll start with the upsides, and you tell me your opinion on these, because as I'm kind of researching around. See if I'm sure you agree with this, but just give me your thought on this. Upside. It may, as we just said, an alternative may add an element of diversification to an investor's portfolio, while at the same time mitigating volatility to a degree. If equity markets go through a rough patch where performance is down, alternatives may offer some upside to alleviate that. I mean,
they may be going up when the markets are going down.
Yeah. You would agree with that.
Right. And that's one of the reasons for adding a discorrelating asset or something outside of the traditional assets, so that not everything is going down at the same time. By the other side, not everything's going to be going up at the same time either.
Yeah. So if stocks alone hit some kind of big bull run, and you've got some alternatives,
out on some of it.
Yeah. But
on the other hand, if stocks go through a downturn, maybe your entire portfolio doesn't go through that downturn at the same time.
Another potential upside that I've researched or seen is that there may be lower transaction costs associated with alternatives. Short-term investing often comes with high levels of turnover, I guess, and
I'm going to say
leading to higher cost of transactions. What do you think of that?
I think that's backwards.
Okay.
I have not. Usually the alternative investing that I have seen tends to come with costs. More costs.
I think what they're saying is the illiquidity means that there's not a lot of trading going back and forth But you would disagree with that.
And I guess it depends on how we're looking at it.
Okay.
If I have multiple properties, I'm probably going to have a property manager, and that property manager is charging me a fee. That's a fee. The cost to get in and out. There's, specifically talking about real estate. It ain't cheap to buy real estate.
Well, even if you're using leverage, it's not.
Yeah,
you try to buy $1 million property.
But there's commissions, brokers on going in and out. So there are fees involved. And so if you're doing it by yourself, you're buying one-off properties here and there, you have to pay the commissions up front, and then you're either spending your time managing it or you're hiring a property manager. And it could be very beneficial. I'm not saying this is bad. I'm just saying if you're spending your time, I had somebody manage, I knew somebody who managed, he had a mid-level job, just a regular blue-collar guy, but he started buying properties and fixing them, and he had like 12, 15 properties. This is back in the 80s. And they were all leased out or rented out, and only one of them had a debt at any given time. And he was making a lot more money on his real estate than he was from his regular day job.
Sure.
But he spent a lot of time. He and his wife spent their weekends working on these properties. They did a lot. They did most of the management themselves. That was their...
That's a cost.
But they did that. They didn't travel. They didn't do other things.
Okay.
So they were paying themselves to do this by not paying somebody else.
But that's a cost.
That's a cost. So
Okay.
it came at a value to them. So otherwise they would have had to hire a property manager, and their income would have been a lot. So I think that alternatives, what I have seen, typically the fees are higher, but I guess you can make an argument either way.
Well, I could see that. That's why I wanted your opinion. One more potential upside. In some instances, alternatives may offer certain tax benefits that aren't found in conventional asset classes.
True. I mean, again, going back to real estate. Yeah, if you own the real estate property, you can use, depending on your income levels, the depreciation to offset the income that's currently coming in. Now, anything the government gives us, they may take away at some point in the future. So you may have to pay that tax benefit back when you sell it through recapture of depreciation. But other ones, there are tax programs that are designed, as this really big back in the 80s, but less so now, where you put in $100,000 into an investment and you get a $70,000 tax write-off the first year or something.
I haven't heard about those lately. But
no, there's not as many, but there were. But
Okay.
they're using the underlying investment and the tax laws that are available on the underlying investment to pass through to the investor to be able to make it more tax efficient.
Okay. All right. I could see that. Now let's run some downsides here. And I imagine you'll probably agree with these. Well, you've already said this. Most alternative investments are less liquid than conventional assets and can create problems for those who find themselves short of cash and have to tap into those funds. I mean, you should not use short-term solve a short-term need with this type of very long-term asset.
These types of alternatives typically are longer. They're kind of like what we call bucket number 3. When we talk bucket number 3, we're talking typically stock market investments because we want to have available time to mitigate downturns. But a stock market investment, you can sell any given minute of any given open day. I mean, so from a certain liquidity definition, I can turn it into cash very quickly. You maybe shouldn't turn it into cash,
but you can.
The alternative investments typically are liquid where you can't turn them into cash, which is both good and bad. Sometimes it's bad because you need the cash, and sometimes it's good because that way you don't shoot yourself in the foot by getting out at the wrong time. So the illiquid nature of it can be either good or bad. Where I see this having an issue is what people that get into real estate with a very rosy picture of real estate, and they go into it, and then they have a period of they didn't put a big down payment down. They've got a high monthly payment, high monthly cost, and then annual cost with property tax and everything, and they lose a tenant for a little while. And usually when you lose a tenant, not only do you lose the income, but you got to go in and fix things. Or in some cases, you're mandated to go in and paint and do other things to upgrade after somebody's been there. So you have no income and you have expenses. Well, if we have a downturn in the pricing from time to time, you could be upside down. And if you don't have the money to pay the payment, you can lose it. And that can be a problem. So when you have to understand, and this is where the sophistication comes in, you have to understand what you're doing. If I buy a stock, I don't have to have a tremendous amount of sophistication to know, hey, I paid $10 for it. It went down to 7. Oh, well, it went up to 8, or it went up to 12, 14. I don't have to be a rocket scientist to know whether I'm making or losing money. I'm also not doing anything. With real estate or some of these other alternatives, you gotta have a little bit better understanding of what you're getting into.
Absolutely, and that lack of liquidity can hurt people who don't know what they're getting into.
Very much so.
As you said, here's another downside. Like virtually other investment alternatives are subject to down cycles, and some of them can be quite lengthy, as we saw with housing, right?
Well, and that's
so again, it's got to be a long-term decision.
If you look at the stock market returns, it's fairly jagged, up and down, boom, boom, boom. It's all over the place. Mm-hmm. There may be a trend over time, but it can go up and down very quickly. And even downturns and recoveries happen. Look at the 2020 downturn.
2 months?
It was down like 18, 19% in 6 weeks, and it had recovered by 6 weeks later. Yeah. That's a fairly sharp entry. Even, if you look at typical downturns are a year and a half, and then they start to recover. And typical recoveries may be 5, 6, 7 years after that. On the other hand, real estate tends to be a much longer wavelength, where if we go back in time, we hit a high in the personal real estate, at least in our area, in like 1990. And then it didn't hit the bottom until 1995, 1996. It didn't recover
come up until late
90s. Later than later
than
2000.
Look at commodities. I mean, how long is something like gold? I mean, that could be down for 20 years.
Right, and then it spikes. And that's the problem with gold, is that over long periods of time, it gives you a return equal to roughly inflation.
That's historically been the case.
At times, it can do exceptionally well or exceptionally poor.
Right. Another downside. Alternatives can be difficult to understand and may carry risks that an uninformed investor is unwilling to accept. Well, again, this is sort of what you've been saying, right?
And it depends on whether you're getting into it individually, like you're buying one property, or you're buying into a REIT or something of that nature. If you're buying into a REIT, you're getting diversification. You're getting potentially somebody else managing it. You don't have to do it, but you better understand the fee structure, what's going on, and that's where you have to understand, how long am I going to be in this? Is there a line in the sand, or is there a line in stone that I can get out of this? And what am I getting into?
It's true. I mean, these are things that you know. Do I get into real estate because my best friend, I made a killing in the market? Real estate is great. It was perfect. Does that mean it's going to happen to you? No.
And we talk about real estate. Another one is cryptos. I mean, most people that are getting into crypto have no idea what's going on. They just know that they can get rich, or they think they can get rich.
In their head,
yes.
They think.
But do they really know what they're getting into? To me, it's almost like a commodity that you have no idea what news is going to affect it one way or the other.
Yeah, you got to be very careful there.
So you've got to be a different kind of investor for that world.
As is true for almost any alternatives,
true.
I would say. One last downside that I think we should talk about here. They've said that there can be a low level of transparency when compared with, say, publicly traded stocks, ETFs, mutual funds. There could be higher management fees, as you said. Unclear performance valuations. I mean, how do you really know how it's doing?
Well, the problem is
against some kind of benchmark.
A publicly traded stock, you know what the share price is because you can look it up minute by minute on the day. The building that Apple occupies in X city, how do you know what the value of that building is until you put it out for sale and you have somebody offer you? Yeah, that you can get an estimate of it. So you don't really know what the value is going forward until you actually try to sell it. Mm-hmm. And then it takes, if you're talking about a building like I was just talking about, $100 million building, $50 million building, you don't just put it up for sale by putting a sign on the front lawn. You do studies and you pay money to get an idea of what you can sell it for and whether there's an appetite for it, and whether or not you're willing to sell it for what that appetite out there is with. So it costs money to sell it. So yes, when it comes to alternatives, sometimes it's very difficult to actually understand what my value is. And you better understand business. I mean, when you buy a stock, do you check the financials?
You mean of the company?
Yes.
I don't research.
Most
that.
people don't.
No.
They hear about a stock and they say, "Ooh, that's cool. I want that."
Right.
but they don't check the financials.
I would hope there's some manager that's doing that for me and
Right.
recommending.
When you're buying alternatives, though, you really need to check the financials to see what kind of leverage you're using to buy the assets, or what kind of fees are being charged, what's going on. So I think you have another layer of due diligence when you're dealing with alternatives than you do when you personally are buying stocks.
Yeah, I think people can certainly get caught up in the hype, especially when you see it on TV, and it was nothing but housing market in the mid 2000s.
And how does the average person get into the housing market? Are they going to go out and buy, 4 or 5 $500,000 homes?
Well, of course they, with the loans that they had back then,
the ninja loans,
yes,
yeah, 2004,
no income,
5, 6,
no job, whatever,
no income, no job.
Yeah. Beware of things like that, because it will come back and bite you, no question. So just to wrap this up, when you talk about alternatives in a bucket strategy, this is a bucket 3, certainly. I would expect. Or a hybrid, an offshoot of a bucket 3.
You treat it as it's going to be a long-term investment.
Yeah.
You need to give it time for different reasons, but sometimes just because you can't get out of it quickly. But yeah, it has risk. I'm not saying it doesn't have risk. It has, in many cases, a different risk profile than the typical stock investment, and that's why you're buying it. You're buying it for different reasons, but it is not expected to be a bucket number 1, low volatility, no volatility.
Yeah.
Anything that has safety and liquidity to it.
This is something you should talk to your financial advisor about. And the folks at Lucia Capital Group, they can certainly talk to you about it and give you some idea, but know what you're getting into if you're going to do that, and why you may consider it. If you want to get in touch with any of the advisors at Lucia Capital Group, 800-644-1150, 800-644-1150. We thank them for being our long time sponsors. You can also go online at the website, luciacap.com, LUCIACAP.com. I know there's some videos up there on things like alternative investments, some things you could take a look at if you want some more information, but certainly do your homework on that, and an advisor can guide you along the way. You want to subscribe to this podcast, Spotify, iTunes, you can do so. We're back, as I said, for season number whatever it is. We got a lot more to talk about.
For another season.
As I guess we were saying before, how do you determine what a season is? I don't know, 10, 11, 12 episodes, something like that. Then we take a break. Anyway, we're going to have a whole lot more fun topics and coming up this particular season. Subscribe to it and listen to this podcast. Become a regular listener, and send us your emails, too. We'd love to hear from you. That's all we've got for this time. For Professor Rick Plum, CFP professional, I'm your podcast host, Johnny Dean. Thanks so much for listening. Talk to you next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Investments in non-traded real estate investment trusts, REITs, are subject to significant risks. These risks include, but are not limited to, limiting operating histories, reliance on the advisors, conflicts of interests, payment of substantial fees to the advisors and their affiliates, and illiquidity. If you are able to redeem shares, they will generally be redeemed for less than the original amount invested. Investing in these products may not be suitable for all investors. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether the risks associated with an investment in the shares are compatible with their investment objectives. You should carefully consider the investment objectives, risks, charges, and expenses of a non-traded REIT before investing. The prospectus, which contains this and other important information, can be obtained from your financial advisor. You should read it carefully before investing or sending money. ETFs are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Money market mutual funds, though traditionally lacking federal insurance and not without risk, are highly regulated under federal law. Before investing, carefully consider an ETF, a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. The regulation of cryptocurrencies remains in an unsettled state. Profits in cryptocurrency trading are taxable as capital gains in the U.S. The lack of a centralized authority can be a legal and financial risk to cryptocurrency owners. It is important to keep in mind that investments in fixed income products are subject to liquidity risk, interest rate risk, financial risk, inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.